Welcome back to The Explainer. I am absolutely thrilled to have you here today. Look, if you're a focused learner trying to truly understand the mechanics of wealth building, you're in the right place. Today, we're demystifying the stock market. We hear about stocks literally every single day on the news, right? But so often, the actual fundamentals just get completely lost in a sea of flashing red and green numbers and dense financial jargon. So in this explainer, we're stripping all of that away to look at the solid foundation beneath the whole system. But before we get into the weeds, here's a crazy piece of trivia for you. The stock market isn't some modern digital invention. It's actually been around for hundreds of years. Look at the year 1602. That is when the Amsterdam Stock Exchange was founded, which most people agree was the world's very first formal stock market. And why was it created? Specifically to trade shares of the Dutch East India Company. This was a shipping company so massive, taking on journeys so incredibly perilous, that they desperately needed a way to spread their enormous risk across thousands of individual investors. That simple, practical need to share risk and reward, that evolved directly into the modern digital trading we use today. Here's our roadmap for today's explainer. What is a stock? A look inside the stock market, how stocks actually make money, calculating your total return, and finally, the risk of individual stocks. Let's get to it. Section 1. What exactly is a stock? Picture this. A company needs money to grow. Maybe they want to build a brand new factory, hire a bunch of people, or launch some exciting new product. When faced with this need for cash, the company basically has two main choices. Option A is taking on debt, borrowing money that has to be paid back with interest. Option B, they can sell pieces of ownership to the public. And that act of selling ownership stakes, that is what we call issuing stock. So the key takeaway here is that a stock, or a share, or equity, whatever you want to call it, it's not just a glowing ticker symbol on a screen. It is a literal unit of ownership in a corporation. When you buy a stock, you become a shareholder. You are a partial owner of that actual real-world business. And obviously, the more shares you own, the bigger your piece of the company is. And this donut chart brilliantly illustrates how fractional ownership plays out. Let's say a company has exactly 1 million shares floating around out there, and you go out and buy 100 of them. Well, you now own 0.01% of the company. Yes, it's a tiny slice of the pie, but it's a very real slice. You own a fraction of that business perfectly proportional to the shares you hold. Now you might be wondering, why does my tiny slice even matter? Well, because even with a tiny fraction, your shares give you actual, legally binding rights. As a shareholder, you're entitled to a proportional cut of any dividends paid out. You actually get a vote on major company decisions. And if the company is ever sold or liquidated, you get your proportional share of the assets. You are an owner with the rights of an owner. Moving on to Section 2, inside the stock market. Because think about it, you can't just walk up to a company's headquarters, knock on the front door, and ask to buy shares directly from the receptionist, right? Instead, trades happen through a stock exchange. This is an organized marketplace designed entirely to connect buyers and sellers. Stock exchanges are absolutely crucial because they provide transparency, they enforce strict regulations to keep things fair, and they provide liquidity, meaning it's incredibly easy for you to buy or sell your shares pretty much whenever you want during trading hours. And how do we measure how big a company actually is once it's trading on that exchange? We use a metric called market capitalization, or market cap for short. It's just the total market value of all of a company's outstanding shares. The math is beautifully simple. Just multiply the current stock price by the total number of shares. So, if a stock is trading at $50 and there are 10 million shares in existence, boom, that company has a market cap of $500 million.
All right, Section 3, how stocks make money.
Let's keep this super simple. There are exactly two ways your stock investment actually puts money in your pocket. Number 1, price appreciation. Number 2, dividends. That is literally it. Let's break down both of these wealth-building mechanisms. First up is a capital gain. This is that classic buy low, sell high scenario we all associate with the stock market. A capital gain is simply the profit you make when the stock's price goes up and you sell your investment for more than you originally paid for it. For example, if you buy a stock at $30 and later sell it at $45, you just locked in a crisp $15 gain per share. The second way is through a dividend. Remember how we just talked about you being a partial owner? Well, when a company turns a profit, they have a choice. They can reinvest all that cash back into the business, or they can hand some of it straight back to the owners, the shareholders. A dividend is just a cash payment. usually sent out every quarter, representing your share of the profits. This means some companies simply hand you cash 4 times a year without you having to sell a single share. Not a bad deal, right?
Next up, Section 4, calculating your total return.
Now, please don't let this math intimidate you. This formula is actually incredibly straightforward. Your total return just accounts for everything you gained. You take your sell price, subtract your original buy price, add in any dividends per share you collected along the way, and then divide that whole number by your original buy price. Multiply by 100 to get a clean percentage, and you've got your total return.
Let's actually walk through an example step by step so you can see exactly how this works in real life. It's just 2 easy steps. Identify your numbers and plug them in. Okay, imagine this scenario. You buy 1 share for $50. Over the course of the next year, the company pays you $2 in dividends. Eventually, you decide to sell that share for $65. So your total profit is that $15 capital gain from the price jump plus the $2 in dividends, meaning you made $17 total. Now, let's see how this builds. If we plug that $17 of total profit into our $50 starting price, the math gives us a massive 34% total return on your investment. Seriously, that is the magic of combining price appreciation with dividend income. Let's do one more quick check to really lock this in. This time, imagine your buy price is $80. While you hold the stock, you get $1.50 in dividends. Later, you sell for $88. Your capital gain is $8 plus your $1.50 dividend, bringing your total profit to $9.50. Run those numbers through our formula, dividing that $9.50 profit by your $80 initial investment, and you get a very solid 11.875% return. Once again, this just proves how absolutely crucial it is to track both dividends and capital gains when you're looking at your wealth. Finally, Section 5, the risk of individual stocks. All right, time for a bit of a reality check. Picking individual stocks is inherently risky. If you take a huge chunk of your hard-earned savings and dump it into just 1 or 2 individual companies, you are concentrating your risk enormously. If that one specific company struggles, your money plummets with it. And honestly, even highly trained pros who analyze stocks full-time with massive resources at their fingertips consistently fail to beat the market average over the long haul. So this leaves us with a pretty massive, provocative question to end on today. If pouring your money into single, individual stocks is too risky even for the full-time professionals on Wall Street, how on earth are the rest of us supposed to safely invest and capture those amazing returns we just calculated? What is the sensible path forward? Well, that points directly to the sheer power of diversified funds, which is exactly what we're going to tackle in our next explainer. Until then, keep learning and stay focused.